For months, the entire market was held captive by one single story. You could almost call it a consensus hallucination, and it was driving nearly every investment decision out there.
The narrative was, well, it was simple. The US economy, strained by high interest rates and all these global headwinds, it was just destined for a cool down. And this wasn't just some casual forecast. No, this was the bedrock, the foundation for asset allocation and risk models all across Wall Street.
And it was a story so profoundly wrong that it now threatens to trigger a violent repricing across every single asset class.
That right there, that is the real GDP growth for the third quarter. A number that didn't just challenge the consensus, it absolutely obliterated it.
So you see, this isn't just another data point we're talking about. It's a fundamental paradigm shift. One that changes, it changes everything.
The slowdown thesis is dead. So the question now is, what comes next? And where is all that capital forced to move in this new reality?
So how in the world did a 4.3% growth rate just appear when everyone was looking the other way? Well, let's be clear, this wasn't some fluke. It was a confluence of powerful underlying forces. And the strength was just incredibly broad-based. I mean, it all started with the resilient American consumer, who just flat out refused to stop spending. But they weren't alone in this. You had favorable trade dynamics and government spending adding even more fuel to the fire.
And for anyone out there who thinks, oh, this is just inventory games or some statistical noise, well, the growth in real final sales to private domestic purchasers, that tells the real story. This is the clean number. It's the true signal of underlying demand. And let me tell you, an economy with 3% core private demand isn't on the brink of recession. No way.
This surge wasn't some kind of accident. No, recent trade policy actually created this powerful dual-thrust engine. On one hand, you've got higher tariffs, which reduced imports, and that mathematically boosts GDP. And on the other hand, you have new agreements that increased exports of key goods. It's like a classic pincer movement on the trade balance. Really smart, actually.
But, and there's always a but, this powerful growth didn't happen in a vacuum. It brought an old enemy right back to the forefront.
And here's the problem. You see, the Fed's favorite inflation gauge, the PCE price index, it shows core inflation. The sticky underlying trend is running at 2.9%. That is nearly a full percentage point above their target. The economy is hot for sure, but so are prices. So the crucial point here is this. The very policies driving this boom, things like restricting cheaper imports and stimulating domestic demand, are inherently inflationary. They're working to boost GDP, absolutely, but they're also what's preventing inflation from falling back to that 2% target. This combination of high growth and sticky inflation, it creates an absolute trap for the Federal Reserve, and it completely 100% changes the outlook for interest rates.
For the last year, the entire market has been betting on aggressive Fed rate cuts. This new data makes that bet look, incredibly dangerous. But why? Because the Fed is now caught between two terrible options. It's a real rock and a hard place. If they cut rates into a 4.3% growth environment, they risk overheating an economy that's already hot. But if they cut rates while inflation is still hanging around 3%, they risk reigniting that whole price spiral they fought so hard to contain. So the path of least resistance is to do nothing. The higher for longer reality, it's here.
You see, understanding this dilemma is the whole key. The old playbook is completely useless now. So the real question becomes, where does the money flow from here?
And that brings us to the payoff. With the slowdown story dead and rate cuts basically off the table, capital has to find a new home. So, welcome to the Great Reallocation.
We're focused on two sectors that benefit directly from this new regime. First, and this one is probably the most counterintuitive, are business development companies, or BDCs. The market has just punished them based on fears that are now, they're completely invalidated. The bear case was so simple. A weak economy would cause a wave of defaults, and then Fed rate cuts would just crush their income. But now, what's the reality? A strong economy means their borrowers are healthy, so that credit risk is fading. And with rates staying higher for longer, that income cliff they were all supposed to fall off of, it's been canceled. Their biggest weaknesses have literally just become their greatest strengths.
And the market, it just hasn't caught up yet. You've got high-quality names like Ares Capital, ARC, Blackstone Secured Lending, BXSL, Main Street Capital, MAIN, they're all still trading at discounts. Even alternative asset managers, heavy in private credit like Blue Owl Capital, ticker OW, they look incredibly attractive right now.
They offer this potent combination of high yield and direct exposure to economic growth. Okay, so the second pillar is energy. Honestly, it's the most logical, yet somehow overlooked play in this new environment. We've seen this massive rally in inflation hedges like gold and copper, but let's be real, that's become a very crowded trade. Energy offers the same exact protection, but with a much better valuation. Think about it. An economy growing at over 4% is an energy-hungry economy. We are really bullish on midstream companies like Energy Transfer, ticker ET, and these high-quality, undervalued producers like Canadian Natural Resources, CNQ. And for broader exposure, ETFs like XLE or AMLP are also really compelling.
So the new playbook is crystal clear. The facts on the ground have changed, and portfolios have to adapt. You sell the assets that needed a slowdown to work, you buy that combination of growth and yield that you get from BDCs, and you buy the undervalued inflation hedge you find in the energy sector. And that right there is the central question. While most people are still watching the markets react to old news, this channel is focused on explaining why they move before it happens. If you want to stay ahead of major shifts just like this one, this is where that work continues.